So right now we are under finance leases, right? Actually, remember we are dealing with lessor accounting, right? Because under lessor accounting, we have to distinguish between finance leases and operating leases, right? I hope you get me. Maybe I get back here. We are dealing with lessor accounting. I'm repeating again. Under lessee accounting, no need to distinguish between finance lease and operating lease. But under lessor accounting, the one giving out the assets to the lessee, we need to distinguish between finance lease and operating lease. Then after this, I'm going back to the question, to the explanation, sorry. Okay, so we have the finance lease here. Now, how do they with finance lease? It's nothing much more. We have already spoken a lot of this about this and operating under what under lease accounting. Initial treatment now. How do we deal with initial treatment? At the inception or at the commencement of the lease, lessors present the assets held under a finance lease and is a receivable. This is what we do. You know, let me tell you one thing. Is for the when dealing with the lease accounting, we say that we debit right of use asset and then we credit lease liability, right? Now that liability to the lessee is an asset to the lessor. Do you get me? I don't know if you are getting. Let me do this. Let me do an illustration. It's something very, very important here. Let's do this. First of all, to make you get this very, very well, I would first say it's the accounting, but maybe I would also say lessor accounting here. Lessor accounting just like this. Okay. So when we deal with the accounting, we usually say debit right of those assets and then credit what? Credit lease liability, something like this, right? Okay, now ask yourself, and of course, analysis accounting would say that there is no need to distinguish whether it's a finance lease or operating lease, no distinction. But here we distinguish. Now, when dealing with lessor accounting, to make matters simple is if the lessee has a lease liability, this lease liability to the lessor should be the right, should be the asset. So that's why if for the lessor, we say debit lease receivable, right? Receivable. You could just say lease receivable instead of lease liability. You say lease receivable. You expect to receive something from the lessee, right? Yes, and then we'll see it for the credit side what to do, right? So that's why most of the values would just come from the lease liability component which you computed already. Okay, so just get the graph here. That's why they say the value of the receivable is calculated as the present value of the following. Now take a look. Under lease liability, we also use the fixed payment, which has profit. Under lease liability, we use the variable payment, which was the consumer index, for example, that we use. Under lessee accounting, we use the residual value guarantee because the lessee expects to pay you residual value guarantees. Put them here. But here we have unguaranteed residual value. Actually, if unguaranteed residual value, the lessee won't necessarily give you, but you have the residual value that is unguaranteed. You still have its value, so you can also add it. So at this until at this point, only this figure here does not appear under the lease liability component. Purchase options that are reasonably certain to be exercised. This was also there under the lease liability. Termination penalties if the lease term reflects the expectation that this will be incurred. Did you just see this? Except for the unguaranteed residual value, all the remaining components also appear. All the remaining components also appear under the lease liability. So you can just get a picture of that. You are just repeating the same thing. But instead of having a liability, you will now be having an asset. Right. That's just the point. No issue. Subsequent treatment is easy. Subsequent treatment has no issue at all. You know, let me just write that amortization table again before going any further. You need to know how to simplify matters for yourself, right? What did we do for the amortization? We just say it in how we are. We can just have the balance in B. So just like for the lease liability, And maybe you are paid at the end of the year. So first of all, you have to incur the finance income. Instead of finance cost, it's now finance income. You know, finance income goes to the statement of profit or loss, right? And then you now have to call fine. Actually, you have to be to receive something now. They'll pay you. So it's a cash receipt, not payment. It's the receipt. It's for the little I need to just say payment, and at the end we have the balance TV. Just like this, no, it's no big deal at all. It's for the video sale balance TV, finance cost, payment, and here closing balance. So we say that finance cost stays in the income statement, and also finance income stays in the income statement. Payment is the cash outflow, so stays in the cash statement of cash outflow. Here receipts also goes to the cash inflow, cash flows. Balance TD is a closing balance. The same here is the closing balance. I hope you got this. In case maybe you are receiving money in advance, these receipts would have to precede this finance income, so they would have had to swap. I would first start this way. It would be this way, right? So that's all I wanted to speak of here. Nothing much. That's why I'm just reading this, but that's what I've explained. The carrying amount of the lease receivable is increased by finance income, which is also credited to the statement of profit or loss. Did you see? I said finance income goes to profit or loss, and then it increases the lease receivable. Carrying amount of the lease receivable is reduced by the cash receipt. If you expect to receive something and you have already received something, that means what you are still owed decreases, right? What others are still obliged to bring forward to you actually has been reduced, just like that. So it's nothing much. Maybe let's just we'll take a look at this example. That's why I just given a simple example because it's nothing much the same. Okay, the question says which leases machinery to Toro. Okay, the lease is for 4 years at annual cost of $2,000 payable annually in arrears. Be very careful when you find this rate in advance and in arrears, so they are paid in arrears. The present value of the lease payment is 5,710. The implicit rate in the lease is 15%. Now, do you see some questions like this? They have already given you 5,710, but maybe in case we are the one dealing with it directly, how would you have proceeded to obtain that present value of the lease receivable? Present value should be the sum of what? Future value, but being discounted, right? Just like this, just like we did before. So in that case, they have given that you have to understand, oh, I was going to receive 2,000 year one, 2,000 year two, 2,000 year three, and then 2,000 again year four. So I would have to actually to discount all of these. This one is at the end of year one, so we usually say future value over 1 plus R. The rate given is 15%, so it's 0.15. So 1 plus R is 1.15. It was at the end of year one. So end of year one to now is power 1, so we have 1 here. Here, the end of year 2, so it's over 1.15, but raised to the power of 2 because it's the end of year 2. Do not just read the year. If it is the end, then use that number in the end, right? Beginning of year 3 means the end of year 2. Beginning of year 5 means the end of year 4. So you need to use that concept of time value of money. Then here over 1.15, then raised to the power of 3, and lastly it will be over 1.15 raised to the power of 4. I'm just doing this to show that in case this figure was not given, this is what we would have done to arrive at the figure. So we would have to add all the values for this. I presume that you have a calculator and sometimes you need to try it out by yourself, right? Okay. So right now you have to know that, oh, so all this cash payment, all this cash expected to be paid have been factored in to arrive at this figure. So when you need to manipulate it, it shouldn't be a big deal because you really know what is incorporated inside. All right. So the question says, how should the wage account for the net investment in the lease? This figure net investment in the lease is the lease receivable, so it's no issue, right? How should they account for this? All right. Now, as usual, let's just go to number 7, test understanding. Test understanding number 7. Number 7 here. Now, see. Which recognizes the net investment in the lease as a receivable. You just see. Take a look here. You have here. You have balance here, as I you have finance income, which you use 15%, and you have cash received. So opening balance plus finance cost plus finance income, sorry, minus cash received, you obtain the closing balance, just like that. If you just take a clear look, just look, cash received. Each year, each point you receive cash, actually receivable decreases. That's why you see 2000 here, year 1, year 2, year 3, and year 4. So 2000 has been deducted through all the years, right? Just as you see here. Okay, now if we proceed, you'll find out that the opening balance of this figure here at the very beginning, and to obtain the finance income, you take that rate, you place it in the risk or incremental borrowing rate, and then what? You multiply it by the opening balance. So it's 15%, and this figure here is what gives you 856. To add these, subtract these, you have this opening closing balance. This closing balance would be the opening balance for year 2. Then again, 15% times this figure here, you will obtain 685. Add these two, this one and this one, and less 2000, you will obtain this figure here, and so on and so on. If you proceed, you just find out the last point that will be that, right? Would be nil. Okay, so let's say that you have decided to determine the extract of the statement of financial position at the end of year 1. You know, year 1 is here, year 1 ends here. Right. Now, you know, we are usually used to say trade receivables are the current asset, but here this is the lease receivable. You find out that at the end of year 1, I have to receive this, but 1 year later, it has reduced to this figure here. So just like I showed you previously how to break down the lease liability component into its current and non-current components, you would also have to do the same thing. Since at the end of year 1 is this one, but the end of year 2 is this one, it shows that there is something that decreases within a year, and that would be the current component. But this one would be the non-current component. All right, we're going to see that. Now, extracting the statement of financial position, we have lease receivable, one component, and the other. Do you see the lease receivable at the end of year 1 here, as you see, is this figure, 4,566, right? But it has been broken down into this figure here and this figure here, right? Now, to know the non-current component is here. If the question asks you about year 1, just go to year 2. Go to year 2 and you find that this remains. This is the non-current component, which we put it down here. And the current component is what would have perished from here to here. This one minus this one will obtain 1,315. This is the current component, which can also usually be obtained by taking this one, 2,000 minus 685. But we can just go for that simple method. So this is what we have to do, right? Actually, the other point will just be normal, because maybe if we are told to prepare the income statement, we would say I have the finance income, and this is go under income, the statement of profit or loss. Right? Cash received, we go to the statement of cash flow, just like that. So not much of an issue. Not much of an issue, right? So let's go to something else. Let's go to something else. Let's take a look at this operating leases. After operating leases would be done, we just remain with sale and the leaseback. It's also a fine concept, and you just have to know it. No way. Sale and the leaseback. So as for now, let's go to operating lease. Operating lease are just normal. I think I explained how to do this in the low value assets and assets of short life. So just use the straight line method. Operating lease, you know, let me tell you one thing. When you leave the asset under finance lease, you lose control, right? You are the lessor, you have leased out an asset and the finance lease, you lose control of that asset, right? That's why instead of recognizing that asset in your books, you recognize the lease receivable, and you do not recognize that asset in your books. If you have a plan, you do not recognize, you do not depreciate that plan. No, you say that you have the lease receivable, and you need to recognize that plan. And the one that has obtained that actually recognizes. But an operating lease, even if you are the lessor, that means you still have a lot of control of that asset. So actually, in case maybe you are in that situation, you will still need to recognize that asset in your books. So a lessor recognizes income from operating lease on a straight line basis over the lease term, just like I said you for the low value assets. Any direct costs of negotiating the lease are added to the cost of the underlying asset, just like this. Any direct cost of negotiating the lease, just add them to the cost of the underlying asset, because if you are the lessor and you still have that asset, you will still recognize it in the books. Okay. And so the underlying assets should be depreciated in accordance with a 16 PPE or a 38 intangible assets. Just like normal, you still have that underlying asset, but just depreciate it as normal. If it's a PPE, or maybe it's an intangible asset, just go through it. So this is the situation. Let's take a look at an example and be done with this accounting. Okay. The question is just understanding number 8. Orok hires out industrial plant on long-term operating lease. Okay. No issue. Orok hires out that. If Orok hires out, that means Orok is the lessor, right? They hire out. On 1st January 2021, it entered into a 7-year lease on a motorbike on a mobile crane. The terms of the lease are $175,000 payable on 1st January 2021. That means payable in advance. On the date the lease is entered into, something is paid, followed by 6 rentals of $70,000 payable on 1st January 2022 to 2027. So simply speaking, it's a long 7-year lease, payable at the beginning of each year, while at the very beginning, $75,000 is paid, while $70,000 is paid in the subsequent years. The crane will be returned to Orok on 31st December 2027. Okay, no problem. Orok will receive it back. The crane originally cost $880,000 and has a 25-year life with no residual value, something like this. Originally, it cost this right. So it's something that is in charge and makes the decision. Discuss the accounting treatment of the above in the year ended 31st December 2021. So you have the question like that. In an exam, you won't be able to know directly whether this is the operating legal finance lease, but here actually they have given you, they are telling you that they say you need it on a long-term lease. So first of all, you need to know whether Orok is the lessor or is the lessee. It's obvious that Orok hires out these ones, right? And they receive these figures. So Orok is the lessor. How do we deal with the accounting treatment? Let's go to case understanding number 8. So we have number 8 here, number 8 here. Okay, first of all, we say that Orok holds the crane in its statement of financial position and depreciates it over its useful life. Right. You get this? If you are the lessor, I'm repeating again, if you are the lessor and it is an operating lease, you still stay with your asset in the statement of financial position, because we usually use the straight line. That straight line just recognizes rent directly in the income statement, right? So you still remain with your asset as usual. Orok had an asset worth $880,000, used for 25 years, so you just depreciate it as usual. You get the annual depreciation charge of 5,200, and I think the double entry for depreciation. Debit depreciation in the income statement, then credit that asset by the same figure, 5,200. Now our main point here is the rental income. How do we deal with the rental income? Rental income must be recognized in profit or loss, just like how we deal with low value assets on a straight line basis. How do we do a straight line basis? We say that you add all the lease rentals and find an average, right? Total lease receipts are how much? We are told the first year is 175,000 and then 70,000 for remaining 6 years. So if you this time this is 420 plus 175, you will have 595,000 like that, right? Okay. So remember you have the 7 years. So just find the average, just like we did again. You would have to take this total figure over 7 to obtain 85,000, and then we'll build with one by one for all the years. Now for our case here, we're just dealing with the first year. So we know that at the first year, 175,000 amounts are paid at the beginning of each year. So we received 175,000, right? Let me do this. Let me write the double entries here. Sometimes you find something like this, not try to remember everything. You can just do the double entry and everything will come naturally. Okay, so we'll know that at the beginning of the first year we'll receive debit cash of how much? 175,000 plus like this. And then this is the average rental income. Income is just part of an income statement. Income is of a credit nature. So I credit rental income, right? I come and credit here rental income in the income statement. I'm repeating again in the income what? In the income statement, just like this. And I just say that I have 85,000 just like this, right? Now just ask yourself, what remains here? Why are these not balancing? Why they are not balanced? It's that easy. You just find out that the credit balance actually still owed something. So you have to credit here by the remaining balance, which will be actually 90, right? 175 minus 85 is 90. Now, what would this be? If it's a credit and it's a balance, it goes to statement of financial position. Since it's a credit, it's a liability. And since we had the income, that means that is because a prepaid income, right? A prepaid income, because prepaid income is the income you have received but actually not yet earned, right? So you still need to give out services. So it's a prepaid income, which in this case they just referred to. It's the income I'm still not entitled to receive, but is actually already in my hands, right? So just remind you that you need to work for that. So this is the situation. So it could be something like this before, or maybe presume that you had received only 75, but you had recognized 85 here. It means that you had earned much more than what you had received. So we could say that it was an accrued income. You are still entitled to receive something, right? Yeah, so that's what we just deal with here. Nothing much. It's nothing much, and unless account is nothing much. It's just like that. Okay, now we are just about to go to the last part, but maybe before that, let us just finish with this disclosure. Disclosure are actually just normal things. Later disclosure. Whatever you do in computation is what you need to disclose, so it's nothing much. If you see here, we say the underlying assets to be presented in the statement of financial position according to its nature. Yes, as usual. If it's UCP, it's an intangible asset, just show it in the statement of financial position as we say. For finance lease, IFRS 16 requires lessors to disclose, just like before, profit or loss arising on the sale. For example, finance income, as you have finance income, data about changes in the carrying amount, these are just normal things. It's nothing much important because it's something that what we are dealing with. Operating leases lessors should disclose the maturity analysis of the undiscounted lease payments receivable. So you can just show that out. Because when dealing with operating leases, we do not discount anything. So lessors should just disclose the maturity analysis of the undiscounted lease payments receivable. Okay, now this is just the reference to the conceptual framework is nothing much. Actually, we say the conceptual framework does not override any standards. So when they are against the standard, it's against the standard, we follow the standard. But also, as we said before, IFRS 16 replaced A17, right? Then they changed the leasing accounting. We spoke about this all. They changed the leasing accounting by requiring all leases to recognize an asset and a liability at the inception of the lease. Do you see this? That's why I said when dealing with leasing accounting, in the question, take a look on whether you are asked to account for the lessee or the lessor. You have to be very careful about that. Okay. That's why I thought, however, IFRS 16 did not change the accounting treatment of leases by lessors. So in lessors, that's why we still deal with the same way for finance lease, but also the same way that was used previously in A16 for operating lease. Right. Now, my friends, we are just at the last point of the topic. Let's try to see if we can cope with that. If not, then we'll find an alternative. There is something called sell and leaseback. What is sell and leaseback? Sell and leaseback. Let's say I have a house, or maybe I have a machine, the machine which I really depend to actually to run my life. That machine actually makes a lot of products. It has to run my life. But right now I've run out of cash. I'm not liquid. I need to be liquid. So I just call someone. I sell the machine to them, but under the condition that after that they will leave that machine out to me. So it's like I have the machine. I'll continue staying with the machine, but I'll now be paying. They'll give me a lot of money, and then I'll be paying slowly to them. Actually, the interest, kind of that thing. That's why we say sell and lease back. So if you speak of the word sell and lease back, you should draw a certain conclusion before going any further. Here we are speaking of the thing sell and lease back. We are speaking of these two terms, sell and lease back. Just try to compare them. If you sell something and they lease it back, will you be at the lessor or the lessee? Something is originally, you sell something, that means you sell something that is yours. So initially you were the owner initially. Initially you were the owner, then you sold it. So if you sell something initially, you are the owner. Then after selling it, actually, you lease it. So if you lease it back, that means now you are not the owner, now you are the lessee, right? You are the lessee. And someone that bought, someone that bought, when you sold, someone bought, and ownership transferred, right? New owner to the new owner. Right now, they are leaving it out to you. So they are the lessor, right? I hope you get this. So the concept behind selling the leaseback is like you own something. When initially you owned, it was under possession. Right now, it's still under your possession, but under lease, right? So we call selling the leaseback, something like this. This is the main goal, the main aim of the word selling the leaseback. Okay. Okay, so what we'll just tell you is just normal, we'll just tell you normal things. Maybe we proceed a bit. Now, if an entity sells, the seller becomes the lessee, transferred an asset to another entity, which is the buyer becomes the lessor, and the lease it back. IFRS 16 requires that both entities' assets assess whether the transfer should be accounted for as a sale. The main point here is, in an exam under sell the leaseback, first of all, you have to check on whether the transfer is a sale or not. If the transfer is a sale, there is a way to go. If the transfer is not a sale, it's very easy. You just say it's just like a loan giving. Someone has just given me the loan, right? Given me, I'm still in my house, I'll still stay in my house. Someone has given me money, I'll be paying them. It's like just like a loan, just like they giving me a loan, and then I'll be paying them back little by little. So to know whether the transaction is a sale or not, we usually refer to IFRS 16, revenue from contracts with customers. Don't be sure, people, if you have never gone for IFRS 16, it's just the simple concept just to see if it's a sale or not. You know, you say that you have sold something if actually you have satisfied the performance obligation, right? If you say that you have sold something, that is, you are entitled to recognize the revenue if you have already satisfied the performance obligations to the guy actually to whom you claim to have sold something, right? Okay, so that's why you need to refer to IFRS 16 to decide whether a performance obligation has been satisfied. You know, if you say that you are selling books, you have to have delivered books to someone to say that this is it's truly a sale. You say that you have sold books and this is a sale while you have not sold even any book. That's not a performance. You have satisfied performance obligation. You are not entitled to recognize revenue. So it's just like that. This normally occurs when the customer obtains control of what was say promised asset. Yes, you have sold the book to someone, someone had that book, and everything is over. Control of an asset refers to the ability to obtain substantially all of the remaining benefits. Of course, you sell something to them, something becomes under their control, they can decide, they can direct the use of that asset, something like that. You know, they are writing a conceptual framework, but it's not like the conceptual framework actually, you know, the standard is the standard. They're just trying to make comparison. IFRS 16 leases provides a faithful representation of selling the lease, but actually IFRS 16 helps in fighting things like creative accounting practices, right? Because first of all, it is analyzed whether the transfer is a sale or not a sale. So first representation, you know, among the parts it incorporates economic substance, or we usually say substance of a form. I spoke of that concept before. Substance of a form, which take on economic reality rather than the legal form. Right. So you have to deal with these two things. It's whether the transaction is a sale or the transaction is not a sale. If that transfer is not a sale, you know, it's just something very normal, very easy. If the transfer is not a sale, now presume you had a machine. You say that you have sold to someone, and in turn someone got that possession and they gave you a lot of money, and now you are just going to pay them back. We just presume that like just like a loan. It's like they have just given you a loan. So now you have a financial liability and they have the financial asset. Just like that, and everything is over. Okay, so we say that if it's not a sale, the seller or lessee continues to recognize the transferred asset and will recognize the financial liability equal to the transfer proceeds. Very, very normal. The buyer, which is the lessor, will not recognize the transferred asset because if it's not a sale, that means the sale has not taken place. So the buyer cannot recognize the transferred asset. And they recognize the financial asset equal to the transfer proceeds. Just like that. In simple terms, the transfer proceeds are treated as a loan. This was the main point. It's just like a loan. And the detailed accounting treatment actually covered. No, actually, let me just deal with it. Yeah. No need to go there. You know, when dealing with financial assets and financial liability, that is financial instrument. What they just mean here is when we speak of the lessee, you sold something, but the transfer is not a sale. That means you got money, right? If you got money, you have to debit cash, let's say $200 million, and then you are liable to pay. So you have to credit the financial liability, right? Financial what? Liability of the same amount, that is $200 million. Just like that. And then when we speak of the lessor now, lessor actually gave out the money. It's like they financed it. They financed the leasing. So the lessor gave out their money. So they credited, right? They credited their cash of the same amount, which is 200 million. And in turn, they are entitled to receive something from you. So they have in turn created another asset, that is a financial asset. All right, 200 million. Now the explanation says that this is explained more in chapter 12. It's nothing much, you know. When we do with financial assets and financial liability, that is well and deeply explained under financial instruments, right? But all you need to know is just like a normal loan, just like this. So just get that concept. So this is fine, provided that the transfer, sorry, transfer is not a sale, just like that, okay? The transfer is not a sale, that's what you have to do. Okay, so we proceed. Now, what you do when the transfer is a sale? Hey, this is usually the issue, but it's just easy. We really need to finish this. We have about 3 minutes, but we would have to join back to finish just for 20 minutes, I think. Now, what do we do when the transfer is a sale? When the transfer is a sale is when something is very important, something comes out. If the transfer that's qualified is a sale, IFRS states that the seller must measure the right of, if the transfer is really a sale, now we really consider the lease here. We say that you have sold something, and then something is right to say that they have leased out to you, right? Because you cannot say that the transfer is not a sale, and then someone has leased it out to you while they don't own it. That's how you usually ignore that. But this case now would have to have the right of use asset. First of all, just ignore on how we measure it. But simply speaking, if you have the right of use asset, we will also have to recognize the right of use liability, right? Maybe simply speaking before, because the time is just going to end here, let me write that simply. If the transfer is a sale, this is just like a normal lease. So debit right of use asset. I think we spoke about this earlier, right? Right of use asset and the lease. And the lease, after if you have the right of use asset, usually credit lease liability. You know, you should have the ways to proceed with these matters just like this. Now remember, someone has sold something and they have received cash, right? So it's very much obvious that someone would have received cash. Maybe they would have debited some cash, but also they would have removed an asset. You know, they recognize an asset. Someone can get the cash, let's say a certain amount of cash. Let me just write it this way. Oh, I mean this. Someone might debit the cash, and then after debiting the cash, you know, someone gives out something to you. So that asset maybe no longer there. So we say that they have credited a certain asset, which is should be the carrying amount. So we're just going to see this. Then after having this, you could have the balance, which could be the gain or loss. If it's on debit, it's a loss. If it's on credit, it's a gain. Right. Maybe you just have to proceed after this end.